Welcome to Equal Ground Headlines, bringing you your balanced coverage on trending top stories in Canada. I am Samuel B. Williams. Amid escalating trade tensions with the United States, economists and business leaders are increasingly voicing concerns that Canada could soon slide into a recession. As growth projections turn grim and uncertainty mounts over the future of Canada-US economic relations. A recent comprehensive poll of economists conducted by Reuters has dramatically revised Canada's economic outlook downward, highlighting a heightened recession risk due to the ongoing trade conflict initiated by President Trump's administration. Analysts now forecast Canadian GDP growth at just 1.2% for 2025 and an even slower 1.1% for 2026, both well below earlier, more optimistic projections made at the beginning of the year. This pessimistic revision is primarily attributed to sustained U.S. tariffs on critical Canadian exports such as steel, aluminum, and automobile. While the Trump administration briefly paused certain tariffs earlier this year, it notably maintained harsh levies on key industries, leading economists to warn of persistent economic disruption. These tariffs alone are estimated to shave nearly a full percentage point off Canadian growth, directly impacting employment, investment, and consumer spending power. Furthermore, economists warn that sustained tariffs pose significant risks beyond just slower economic expansion. Already, job creation in Canada has slowed significantly over recent months, reflecting cautiousness among businesses reluctant to expand amid unpredictable trade conditions. February's job growth was flat, and March recorded an outright decline, creating anxiety among policymakers and households alike. Consumer confidence, historically a robust indicator of economic health, is showing signs of wavering. With rising prices on imported goods and uncertainty about future job security, Canadians are increasingly hesitant to spend, potentially exacerbating economic downturn conditions. Retail sales data in recent months reflect this growing conservatism, further clouding the economic outlook. Against this backdrop, analysts are closely watching the Bank of Canada's monetary policy response. Most experts now expect Governor Tiff Macklem and his colleagues to maintain the current benchmark interest rate at 2.75% in the near term, carefully assessing the evolving situation. However, economists widely predict that further economic softening will compel the central bank to enact interest rate cuts by the third quarter, aiming to stimulate lending, investment, and consumption to prevent recessionary conditions. Industry representatives and business chambers across Canada are urging immediate government intervention to mitigate economic damage. They call for targeted financial support to businesses severely impacted by tariffs, alongside strategic investments to diversify Canada's export markets beyond the United States, focusing heavily on opportunities in Europe, Asia, and other emerging markets. Yet political response has been complicated by the ongoing federal election campaign, where economic issues have become a battleground. Liberal leader Mark Carney advocates aggressive investments and strategic economic diversification away from U.S. dependence, arguing it as essential to securing Canada's economic future. Conservative leader Pierre Poilievre, however, has advocated immediate diplomatic solutions, emphasizing tariff removal to restore traditional trading patterns swiftly. Ultimately, Canada's economic trajectory in the months ahead hinges critically on how quickly trade tensions are resolved or escalated. The collective message from economists, business leaders, and policymakers is clear. Without resolution or strategic response, Canada could soon face economic turmoil reminiscent of historical recessions, with tangible impacts on employment, investment, and household prosperity.